When you're looking at a company's financial statements, it's easy to just glance past the word inventory. It seems so simple, right? It's just the value of all the stuff they have waiting to be sold. But here's the thing. It is so much more than that. The way a company actually values that inventory, well, that's a huge strategic decision that can completely change its profits, its tax bill, and the entire story it tells the world. So let's dive in and really unpack this financial secret.
And this brings us to the central puzzle we're going to solve today. I want you to imagine two businesses. They are perfect mirror images of each other. I mean, they buy the same products at the exact same prices, and they sell the exact same amount to their customers. Everything is identical. And yet, when the year ends, one of them can report a much higher profit than the other. So how on earth is that possible? Well, the answer comes down to a single, powerful accounting choice.
And this slide right here shows you the result of that one choice. Take a look. Company A uses a method we'll call FIFO. It reports a high gross profit and it pays high taxes. Company B, on the other hand, uses a method called LIFO. It reports a lower gross profit and this is absolutely crucial, it pays lower taxes. Now remember, it's the same business, just with a different accounting method. This isn't some mistake, it's a deliberate strategy. And understanding this is the key to really reading any financial report. Okay, so to solve our little puzzle, we have to get our heads around one fundamental idea. And it's a big one. We are not tracking the physical movement of products on a shelf. Forget about that. What we're actually tracking is the movement of their costs as they flow through the accounting system. And that distinction is everything. This is what accountants call a cost flow assumption. Basically, it's a financial model, a set of rules for how to move purchase costs from the balance sheet, which is, a snapshot of what a company owns, over to the income statement, where it becomes the cost of the goods you've actually sold. And these aren't random rules. These assumptions are specifically designed to achieve certain goals, like matching your most current costs to your revenue or minimizing your taxes. So here's how the mechanics of it all work. You start with what you had, you add what you bought, and that gives you the total pool of stuff you could have sold. That number is fixed. But here's the magic trick. Whatever value you assign to your ending inventory directly impacts your cost of goods sold, or COGS. It's like a seesaw. If ending inventory goes up, COGS has to go down. And of course, when your costs go down, your profit goes up. So the whole game is about how you value that ending inventory. That one number determines your profit. So what are these powerful choices? Well, accountants have a toolkit with 3 main methods, and each one tells a completely different financial story. Let's break down these 3 strategic choices: FIFO, LIFO, and weighted average cost. This table gives us a fantastic high-level view. So you've got FIFO, or first in, first out. This assumes you sell your oldest items first, and its main goal is to make your balance sheet, your list of assets, look as strong and current as possible. Then there's LIFO, last in, first out. This assumes you sell your newest items first. Its goal is to match your current costs with your current revenue, and when prices are rising, lower your tax bill. And finally, weighted average cost, or WAC, just smooths everything out by using an average price. Now, the real strategic battle here is usually between FIFO and LIFO. With FIFO, your ending inventory is valued at the most recent, most realistic prices. This gives you a really accurate balance sheet. But with LIFO, your cost of goods sold reflects the most recent prices, which gives your income statement, your report card on profitability, a much better picture of your current performance. So you see the trade-off, right? It's a choice between an accurate balance sheet and a more accurate income statement. And here's where it gets really interesting, especially when prices are going up, which they usually are. This chart says it all. Under FIFO, you expense your older, cheaper inventory first. That means you get a lower cost of goods sold and a higher net income. Looks great for investors, right? But it also means a higher tax bill. Now, under LIFO, you expense your newer, more expensive inventory first. That means a higher COGS, lower reported profit, but, and here's the big payoff, a lower tax bill and more actual cash in the bank. Now, this strategic choice isn't available to everyone. In fact, the accounting world is literally split right down the middle on this. And where a company is based often decides which tools are even in its toolkit to begin with. The big divide is between US GAAP and the International Financial Reporting Standards, or IFRS. LIFO is, for the most part, a US phenomenon. It's allowed under GAAP. But IFRS, which is the standard in over 140 countries, strictly forbids LIFO. So why is that? Well, the international rulemakers believe it can seriously distort the balance sheet by leaving these ancient, totally irrelevant costs sitting there as the value of your current inventory. Now, in the US, there's a pretty big catch if you want to get that LIFO tax break.
It's called the LIFO conformity rule, and it's a simple but really powerful law. If you're going to tell the IRS that you have low profits in order to save on taxes, you have to turn around and tell your shareholders the exact same story. You can't have it both ways. No reporting low profits to the government and then high profits to Wall Street.
So how do you, as an analyst or an investor, see through all these different accounting stories? I mean, how do you possibly compare a LIFO company to a FIFO one? Well, luckily there are specific tools just for that.
Okay, the most important tool by far is something called the LIFO reserve. Companies using LIFO are required to disclose this number. It's basically the cumulative difference between their inventory's LIFO value and what it would have been under FIFO. So all you have to do is add the LIFO reserve back to the inventory number they report, and boom, you've essentially converted their LIFO balance sheet into a FIFO one. It lets you make a true apples-to-apples comparison.
But you have to watch out for a big danger with LIFO, and it's known as LIFO liquidation. This happens when a company sells more stuff than it buys, and it's forced to dig into its really old, really cheap inventory layers from years ago. This matches ancient costs against modern revenues, and it creates this massive one-time spike in profit. People often call these phantom profits because they're not real, they're not sustainable, and they can seriously mislead you about a company's true performance. In the real world, you can see these choices follow pretty clear industry patterns. Retailers that handle things that can go bad, like grocery stores, almost always use FIFO because it just matches their physical reality, first in, first out. But industries with rising costs and big inventories, like oil and gas or auto dealers, often go for LIFO because of the huge tax savings. And what's really interesting is that in a deflationary sector like technology, where costs are actually going down, FIFO can be the smarter choice for saving on taxes. So you see, understanding these inventory methods isn't just some boring accounting exercise. It is a powerful tool. It gives you a much deeper, more nuanced view of any company you look at. Honestly, it's like having a new financial superpower. When you can really distinguish between FIFO and LIFO, you can look right past the reported net income and start to assess the quality of those earnings. You can see the company's real strategy. Are they focused on telling a growth story with high profits for investors? Or are they playing a cash preservation game, maximizing their after-tax cash flow to run the business? The choice of inventory method reveals a massive amount about what management truly prioritizes. So the next time you're looking at a financial statement and you see that simple little line item for inventory, you'll know. You'll know it's not just a number. It's the result of a major strategic choice. It is a key to unlocking a much deeper story about profit, taxes, and cash flow. And the only question is, what story are you going to uncover?